So there are three asset classes. So let me give you broad overview of these asset classes. What's the thought process that we follow in UTI multi-asset allocation fund, and then we'll run through equity strategy as well as fixed income strategy of the fund. First and foremost, equity allocation. So unhedged equity allocation could vary from 40 to 80% in case of UTI multi-asset allocation fund. We analyze various factors which could influence market return, but we found that four valuation oriented factors are having consistently high correlation with future market return. So typically whenever market valuations are cheaper, generally forward returns are better, and vice versa. Vetri, while showing our model, he also mentioned that whenever model has signal significant increase in equity allocation, generally forward returns are better, and vice versa. So that's what we use in UTI multi-asset allocation fund. When it comes to gold, equity as an asset class, you can gauge based on valuation, based on earnings growth, but there is no such element available for gold. Generally, between gold and equity, the performance keep varying. Sometimes gold performs better, sometimes equity as an asset class perform better. So we use gold to equity ratio to gauge gold allocation in the fund. I'll walk you through this particular element in subsequent slide. While residual allocation is invested in fixed income, and we follow quality and liquidity approach when it comes to fixed income strategy of the fund. Right. So here we have shown you equity allocation in the fund, how it has moved in last 3-4 years. At the same time, Nifty 50 PRI index on right hand side. So as you can see here, there is indirect correlation between asset class allocation as well as market valuations and market levels. Typically, whenever market valuations are expensive, model signals lower equity allocation, and vice versa. Whenever market corrects and valuations become cheaper, generally model signal increase equity allocation. So as you can gauge here that when market was trading at expensive valuation early last year, typically equity allocation was falling, and we maintained about 47% equity allocation till about September 2024. And in last 6 months, we have seen that markets have been extremely volatile. Markets have corrected about 15 to 20% from the peak. So our equity allocation has risen from 47% to 62% in last 4 to 6 month period, mainly because of valuation becoming much more comfortable in the interim. So in the sense, the model has triggered twice. Generally, we follow 7% tolerance band. So the model has triggered twice in last 6 months. So that's why equity allocation has risen from 47% to 62% now. When it comes to gold allocation, as I mentioned earlier, we use gold to equity ratio. So let me broadly explain this slide to you. The green line is basically gold to equity ratio movement in last 15-20 year period. The middle line, blue line, is 10-year moving average gold to equity ratio, while top line is 10-year average, 10-year moving average of gold to equity ratio plus 1 standard deviation. Similarly, the green line is mean minus 1 standard deviation. So these lines provides you signal whether gold to equity ratio is extremely expensive or gold to equity ratio is extremely cheap. So whenever the gold to equity ratio is below green line, typically that's the right time to increase gold allocation. And whenever gold to equity ratio is above red line, that's the time to reduce gold allocation. And why I'm saying so? Because whenever gold to equity ratio is significantly cheaper as compared to 10-year moving average, typically subsequent 1-year gold performance is much better. So on bottom left table, you can see here, we have mentioned that whenever gold to equity ratio is above plus 1 standard deviation, there are about 10% observations in last 25 years. In such instances, next 1 year gold returns is minus 4%. With just about 17% probability of generating more than 8%. Typically, substitute of gold in our fund is fixed income. So that's why we are showing you what is the probability of generating more than 8% return whenever gold is trading at either plus 1 standard deviation or minus 1 standard deviation. Contrary to this, whenever gold to equity ratio is significantly below mean, which is below minus 1 standard deviation, there are 22% such observation in last 25 odd years. And on an average, whenever gold to equity ratio is below minus 1 standard deviation, next 1 year average gold returns is about 18%, which is significantly better as compared to long-term averages of gold. At the same time, probability of generating more than 8% return is significantly higher at 66%. So in the sense, in UTI multi-asset allocation fund, we use this analysis to gauge where gold is headed, and accordingly we keep changing allocation towards gold in multi-asset allocation fund. Here we have mentioned how gold allocation has moved in the portfolio. So in last few months, gold allocation has fallen in the for UTI multi-asset allocation fund, mainly because gold is trading at above plus one standard deviation as compared to 10-year average moving average, 10-year moving average.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.